What's going on, you guys? Charles here from the Traders Corner, and today we're going to be talking about a very important topic, especially as it relates to stock investing, and that's the idea of what are earnings and what are earnings beats. So it's going to be a very quick video, so no need to get into the computer and look at anything, but just to get started off very quickly, we're going to look at a very short definition of what are earnings, defined by Investopedia, very common investing site. It's good and bad in some ways, but this is a decent definition. All right, so what are earnings? A company's earnings are its after-tax net income, right? This is the company's bottom line or its profits. So there's kind of a difference between earnings and revenue, even though they can kind of be used interchangeably at times. It's kind of incorrect as it comes to companies, right? Because generally what you see with the revenue is, like we saw there in the definition of earnings is bottom line, whereas revenue is what's called top line. Essentially, all that means is, again, looking at the definition we just looked at, it says after-tax net income. So what is tax? Tax is an expense. Well, net income is also, not only the tax is taken out, but every other expense that the business has to go through to run its business has been taken out as well. Whereas revenue, no expenses have been taken out. Right, so generally you're going to see revenue being much higher than net income. Generally, not all the time, but generally, right? So that's what earnings are as opposed to revenue. Now, what is an earnings beat? Well, an earnings beat, we have to talk about an earnings report. And an earnings report is simply just a company giving a quick snapshot into how they're doing, how they did the past 3 months. So each quarter, a company will come out, give an earnings report, and let people know how they've been doing the past 3 months, how business is looking for the next few months, all that kind of stuff for the rest of the year, right? All that kind of stuff. And each time they come out and report this, like I said, they're reporting their earnings for the past 3 months. So what generally you see is analysts will say, well, it's this part of the year, and let's take Apple, for example. Well, we're looking at Christmas season, so we're anticipating them to make more sales of iPhones, iPads, AirPods as people get new Christmas gifts, right? So maybe their earnings should tick up. So, we're going to say that we're expecting to see them earn, let's say, $1.50 a share, right? In terms of earnings per share, which is another metric that we can make another video about if that's confusing to you. But essentially, we're expecting them to make $1.50 per share. Now, if Apple comes back and they've made $1.51 per share, that's actually an earnings beat, right? Now, it's not generally $1.50, like a hard target like that. Generally, analysts will give you a range, right? But generally, if you're seeing outside that range on the positive end, that's generally called a beat. Whereas if you're seeing outside that range on the negative end, so let's say they're expecting Apple to do from 145 earnings per share to 150 earnings per share, and Apple comes in at 141, that's an earnings miss, right? So that's kind of the idea of what earnings are, and the idea of earnings beats versus misses. And if you own a stock, you definitely want to keep up with kind of the seasonality of when generally does your company beat or miss, and if it beats or misses in a time that's not normal, maybe why did it beat or miss, right? And kind of understanding that can kind of help you understand some key drivers of growth, or start to help you understand some key drivers of growth for the business as a whole. So hope you guys enjoyed this video, man. Hope it provides some value to you. Join us again next time. Thank you.